Good day, sir. I am Christine Anbi Albay of BS Enterprise. In today's presentation, I will discuss about strategy, planning, organization, and control. Without further ado, let's proceed to my discussion. 13.1 Strategy. Strategy is the action taken by managers to attain the goals of the firm. So, strategy is the primary and important tool or tactic for a manager to manage a business to be successful. Having a strategy is a competitive advantage. Once a business has a strategy, it is possible for your business to stand out compared to its rivals. Using an effective strategy can make your business profitable. 13.1.1 Different approaches to strategy formulation. Approaches to strategy formulation, Porter 1985. A selection of an appropriate generic strategy. Cost leadership, product differentiation, focus on a specific segment of a market. So, selection of an appropriate generic strategy according to Porter 1985 is of view that a firm competitive advantages depends on the selection of the most appropriate generic strategy, which incorporates three elements, namely cost leadership, product differentiation, and focus on a specific segment of a market. So if the cost of a product is lower than the competitors, the firm can maximize its sales or profits. If the product is unique, differentiated from the rival's product, and it meets customers' preference, the firm will be able to maintain an edge over its rivals. Again, if the firm has focused on a particular segment of the market, either with a low-cost product or a differentiated product, the concentrated effort will definitely confer a competitive advantages upon it. B. Application of the generic strategy for international business. Configuration and coordination. Porter 1985 developed the generic strategy theory for international business through incorporation of the concept of configuration and coordination. The concept of configuration is based on the value chain concept. It shows whether it is better to concentrate the manufacturing activities in one or two nations and cater to the outside demand through export, or the disparate the manufacturing activities over a number of countries. However, Porter is of the view that configuration alone does not assure competitive advantages unless and until activities in different countries are properly coordinated. Prahlad and Hamel 1990 and Kai 1993. Develop of core competence, inherent availability of less cost resources, better network of relationship within and outside the firm, improve feature of product, improve communication links with the consumer, and improve with the market position. So Prahlad and Hamel 1990 and Kai 1993 is known as competence-based strategy. It is the core competence or the distinctive capability of the firm that put it in a superior position. Core competence can be possessed if the resources physical, financial, technological, and human are available at least cost, conveniently, and without interruption. Again, the existing core competence can be strengthened and new core competence can be built up. Kai is the view that core competence can be improved through better network of relationship within outside of the firm, improve in the quality and features of the product and in communication link with the consumers, and improve in the market position, while Porter emphasizes on generic strategy and Prahlad and Hamel on the competence-based strategy. Yep, 1992, adoption of total global strategy, development of core business strategy, internationalization of core business strategy, and coordinating activities of the firm in different countries. So Yep, 1992 talks about the total global strategy. He suggests a three stages move toward total global strategy. In the first stage, the core business strategy is developed, which include decision on type and pricing of product, customers, markets, and so on. In the second stage, the core strategy is internationalized, which involves inter alia adoption of the product for the global market. Lastly, in the third stage, all the activities of the firm in different countries are integrated. This way, Yip support the two views mentioned above, but places greater stress on the global aspect. The above view boiled down to the simple fact that the international business strategy of a firm manifests in first, the development of core competence, which helps the firm either to market an innovated or differentiated product or to reduce the cost of the existing product so as the earn learn large or profits, and second, adoption of the technology and product, which is known as local customization to suit the local consumers in different market, leading to large profits. 13.1.2 Spectrum of Strategy Formulation. The spectrum of strategy is the international business covers financial, production, marketing, human resources, and other related aspects. The spectrum of international business strategy deals with 1. Sources of fund. 2. Location of manufacturing. 3. Market and product diversification. So, in view of the varied sources of fund, an international manager has to decide from where he can raise funds. He compares not only the cost of the funds among different sources but also consider the fluctuation in the exchange rate of different countries that are borrowed. This is because large fluctuation in the exchange rate raises the effective cost of fund to be raised. Therefore, it is the less effective cost of funds that shape, among the other things, the financial strategy. In such cases, market diversification will tend to reduce risk to offer ample return. It is not only market diversification but also product diversification that is often a crucial strategy of an international firm. If the firm's strategy is to go for product diversification or to enter a new product line, its success depends on whether the revenue stream is case of the new product is negatively correlated with the of existing product, because only then would the risk be lower with a given return. Diversification help achieve physical and financial economies of scale, but its success depends on the strength of the rival firm in the market. 13.1.3 Virus level of strategy formulation. Strategy at the international level depends on whether the structure of the international firm is ethnocentric or polycentric or geocentric. In his view, in ethnocentrism is compatible with dominance of the parent company over the entire network of the firm. The products are standardized and designed primarily for the home country market, but they are sold without any virtual changes by different subsidiaries in different markets. It is not necessary that the products are manufactured in the home country itself. They may be manufactured by any of the subsidiaries where the cost of the lowest, either on amount of cheap labor or cheap raw material. Polycentrism is opposite to ethnocentrism, and so it is opposite to centralized control. It means that polycentric international firms have freestanding subsidiaries that do not have much operational linkage among themselves or with the parent unit. Their products are not standardized. They are adapted freely to suit the local demand of the different countries, with the result that the price decision is taken by the subsidiaries, which are often more aggressive while taking such decision. Geocentrism lies between the two, ethnocentrism and polycentrism. It means that the strategy, like ethnocentric strategy, has a global perspective aiming at minimizing the global profit. But at the same time, like a polycentric strategy, it has a multi-product production system. The strategy reaps the benefits of both the strategy discussed about it and more approximate to real life. Three types of strategy at the international level. First, corporate level strategy allows successful business line to grow, unsuccessful business line to cut short their activities, and also still other to maintain stability. So corporate level strategy may strengthen growth, retrenchment, or stability, or a combination of three. The growth strategy is common as companies usually aim at gradual expansion of their operations, but sometimes they adopt a retrenchment strategy when they have to crucial their operation in view of though competition or macroeconomic trends. Business level strategy is formulated for either minimizing costs for differentiating the product by adding special features therein. If the company has only one line of business, a business level strategy is not formulated, but it becomes essential in case where there is more than one line of business. Although the purpose is served by the corporate level strategy, the business level strategy is formulated for either minimizing costs for differentiating the product by adding special features therein. The cost minimizing strategy, normally possible either through the achievements of economies of scale or through the use of cost reducing technology, may help grab a large share of market and enhance the total profits. This strategy is more useful when the demand for the product is highly price elastic. Third, department level strategy is a prerequisite for sound corporate level or business level strategy. This is because at the department level, customer value is created through low cost and differentiated products. Primary activities consist of manufacturing activities, logistics, and marketing activities have a crucial role to play in lowering the cost or in making a differentiated product. However, this does not mean that the supportive activities are less important. Strengthen of research and development activities, human resources and accounting and financial activities does not support cutting of costs and making the product unique. Thus, if the department level strategy is sound, the corporate level and business level strategy gets valuable support. 13.2 Planning. 13.2.1 Nature of planning process. The process of planning seek to answer questions regarding what the firm expect to achieve and what method the firm is going to use to this end. The process of planning may be short-term or long-term. The former is known as operating planning and it concentrated the day-to-day operation. On the contrary, long planning called strategic planning precedes the operating planning. Moreover, strategic planning are broader and more comprehensive. Inputs for the process come from all parts of the organization and only senior executives involved in the firm's worldwide activities participated in strategic planning. 13.2.2 Steps in the process of strategic planning. There are different steps in the process of strategic planning. First, assessment of the internal environment and internal resources. The assessment of the external environment has a greater relevance in case of an internal company as host country present varying environments. The assessment takes into consideration the present position and the future trends in relation to the size of the market, consumption pattern in different markets, the intensity of competition, and the business linkage in the different markets. When the assessment of external factors incomplete, the firm assess how far the resources available at its disposal are able to meet the desired objectives. If the resources fall short of the requirements, the firm plans for supplementing them. Second, formulation of global strategy. This strategy involves the market as well as the product. As far as the market strategy is concerned, a suitable market representing a sufficiently large demand for the product or having the least competition is selected. The ease with which the parent company can allocated resources is yet another factor that the influence market selection. Also, a foreign market that has some kind of resemble with which existing market is preferred, as an in case it will be easier for the firm to cope with the market demand. Third, development of global programming. These steps include planning mainly with the respect of the degree of product standardization, marketing programming, and local for production. Both standardization of product and adoption of product have merit and demerits. Therefore, the firm needs to assess how much adaptation or standardization of the product can be recommended so as to achieve economies of scale and at the same time attract the customers abroad. 13.2.3 Centralization versus decentralization planning. Planning decision taking at the parent unit is known as centralized planning, but those taken at subsidiary level as decentralization planning. When decisions related to the process of planning are taken at the parent office, it is known as centralization planning. So, when the planning process evolves at the subsidiary level, it is called decentralization planning. In real life, neither of the two existing is its purest form. There is usually a combination of the two. When a product involves intricate technology developed at home, it is often globally standardized, and it's at in this case, the planning is carried on at the parent unit. The subsidiaries have virtually no say in the decision. 13.3 Organizational structure. Organizational structure is a structure of linkage among organs of a firm establishing the root and locus of decision making. Organizational structure provide a root and locus for decision making. It is also provide a system or a basis for reporting and communication networks. The basis of an organization chart, which can be found in any book on management concept, a similar for the both domestic firm and international firm. But since international firms have to face complex problems, the form of the organizational structure is specific to them. The structure of an organization becomes complex with a growing degree of internationalization. 13.3.1 Absence of formal organizational structure. Functional structure is organizational structure based on the nature of functions. In the beginning, when a firm has just begun international transactions, and that too on an ad hoc basis, meaning that the export is only fortuitous. It is the domestic division that the hands exports. The organizational structure is not different from that of a domestic company despite occasional involvement of international business. The structure is either a functional structure or a product structure. In a functional structure, below the chief executive office, the organization is divided into different function divisions such as marketing, finance, production, and so on, and power centers are located in these different divisions. Product structure is organizational structure based on nature of product. In a product structure, below the chief executive officers, the organization is divided into different product groups that allows the firm to segment internal operation in order to comply with the product and market variations. 13.3.2 Creation of an export department. With export activities being deliberated, the firm sets up as an export department as sub-department of marketing. The organizational structure changes the moment the firm begins exporting on a continuous basis. Export activities does not remain fortuitous, rather they are deliberated. In such cases, the firm may set up an export department as a sub-department of marketing, manned by experts in the field of international business. If the international business become a permanent phenomenon, the export department will have some freedom to operate and an international organizational structure will begin to emerge. Nevertheless, priority in this type of organization is mainly the domestic market rather than the foreign market, with the result that the domestic market department maintains an overall control over the export department. 13.3.3 International Division. With exports moving on to a stronger footing, the firm set up an independent international division that assumes the inter-responsibility for international business. There are often cases when the domestic market is preferred despite a clear focus on the international market. It is found in cases when the firm believes that better domestic opportunities still exist. In such cases, though the domestic division concentrates on the manufacturing and on the other domestic activities, the international division performs its functions freely under the supervision of a separated vice presidency. Proper coordination is of course maintained between the two divisions, the domestic division on the other hand and the international division However, the international division fails to cope with the municipality of products and which greater international diversity. This was perhaps the reasons that in the 1990s, many US-based firms changed their organizational structure from a traditional international division based Base 1 to more sophisticated structures. Figure 13.4 represents this type of organizational structure, particularly when the international division is a part of the firm. 13.3.4 Global Division. With foreign operation being more complex and being the prime motive, the firm set up the global division. The global structure may be product structure, area structure, functional structure, customer-oriented structure. Product structure is more common in international business and more suitable in case of a multiple brand system according to Franco 1977. So product structure is more common in international business and more suitable in case of a multiple brand. In this case, there are different product divisions. In each division, there are subdivision. One subdivision looking the manufacturing and sale at home and the other subdivision looking after the sale of foreign subsidiaries. The centralization of manufacturing leads to economies of scale, while decentralization of marketing is often more effective. In this structure, product specification attention is possible, which is significant for competing in different markets. This structure is useful also in the sense of the various functional inputs and needed for a product can easily be balanced. However, coordination among various product groups operating in the same markets is very important in order to avoid duplication of the basic functions. Area structure is organizational structure based on geographic area. In case of area structure, organization is based on the geographic areas, namely Asia, Africa, Latin America, and so on, and the operation is divided accordingly. The parent unit, however, provides coordination support for the worldwide planning. Similarly, as in product structure where product specific attention is possible, area or market specification attention is possible in area structure. When a particular region requires greater attention in view of its own problem, it is given the attention. This structure is more suitable where brands are few but disparity in host country market is quite large. However, it is necessary that experts for each product group are appointed in each of the regions so that any duplication in product management is avoided. Functional structure emphasizes on specific functions such as manufacturing, marketing, finance, and so on. It is more suitable where the products and customer are few and homogeneous. The only problem is that of coordinating personnel of different functional groups. Customer-oriented structure is more relevant where customers are widely heterogeneous and their consumption pattern differs widely. These structures help emphasizes all the different classes of customers. 13.3.5 Multidimensional or matrix structure. Matrix structure is combination of product, area, and functional structure. The global matrix structure is more complex when it combines all the three aspects, product, area, and function. This is found in multi-product firm where one group of product needed area structure of organization, while the other group of products needed functional structure. And for yet another group, product structure is found more appropriate. A firm reaches these particular stages when economies of scale in production researches a new high and the different subsidiaries are able to expand their market beyond their traditional domain. In this case, country level managers report to the both regional and product managers. As a result, of which a balance is created between global or regional needs and the local needs. The matrix structure encourages team response that is very much pertinent in cases where no single person possesses all the information required. 13.3.6 Some other structure. The above-mentioned structures are normally based on the American experience. This is not necessary that international companies of both countries follow the same hierarchical structure. In this sense, the organizational structure is more flexible than mentioned above. Mention a few other structure followed in other countries. For example, European companies use mother-daughter structure where subsidiaries are substantially autonomous. Each subsidiary report directly to the top management. In China, the industrial organizational structure interweighs various levels of the governmental functionaries. In some developing countries, a matrix of government structure is used where various ministries and central agencies come between the highest body of the government and industrial organization. 13.3.7 Coordination among the subunits. Proper coordination, formal or informal smoothness, communication between different units. Proper coordination, smoothness, communication between one unit and another. It is true that there are impediments to effective coordination. Managers at different units may have varying orientation. Formal coordination can be ensured through direct contact among the managers of different subunits. It can also be ensured by giving a manager of a unit the responsibility for coordinating with his counterpart in other unit. In a system of informal coordination, a management network is established through which information is disseminated throughout the organization. The managers of different units known as other either directly or through other managers. 13.4 Process of Control. The process of control had been discussed earlier in this chapter. In fact, it involves examination of the facts to verify whether the set goals have been achieved. To this end, it identifies deviation if any form of the set goals and suggested measure to do away with the factors behind the deviation. The process of control, as it has been said, is more crucial for a multinational enterprise in view of its complex operation, especially on account of large physical and crucial distances and in view of a substantial degree of delegation of authority. Thus, it is very significant to know that the shape of an effective control system should be. 13.4.1 Features of an effective control system. An effective control system must be based on accurate information, and the information regarding performance should be compared with a set of standard. An effective control must be first based on accurate information, second, based on timely information, third, cost effective, and fourth, based on objective. If the parent unit and the subsidiary maintain their accounts in the same currency, there is normally no problem in getting accurate information. But if the currency of the accounts differs, the changes in the exchange rate may blur the reliability of information. Whatever the information is available should be available in time. It is because only then can any strategy of control be applied effectively. Untimely or delayed information loses its relevance. However, in international business, it is the geographic distance that often causes delay. The information should be objective, which means possessing the least possible subjectivity. This is because it is easier to interpret objective information. At the same time, objective decision lead to unbiased decision, which is essentially for initiating a correct control strategy. 13.4.2 Design of control. Control mechanism can be designed in many ways. They vary from one location to the other or from one firm to the other. However, some of the techniques are common. Some of the common techniques are discussed here. Accounting and audit control. Accounting and audit control is normally designed for measuring financial results. The analysis may be show whether the firm is operating up to the set standard or the performance is below the mark. The technique known as standard costing and variance analysis is very common. It is show whether the material use, labor use, or the overhead cost incurred is compatible to the set standard or whether there is any variance. On the contrary, audit control verifies the information provided by financial statements. In other words, it ensures reliability and validity of the reported financial statements. Control through plans, policies, and procedures. This is also known as bureaucratic control or formalized control. It has already been stated that planning and control are closely related. Plans are both long-term and short-term. The short-term plan are often accompanied by annual budgets, and annual budgets serve the purpose of a control mechanism as they refer to short-term guidelines regarding production, marketing, personnel, and other aspects. Again, at the frequent intervals, the actual performance is evaluated against the set plans. The long-term plans are more qualitative in nature and they stress long-term goals. Cultural control. Cultural control is a distinct personal with corporate control. Cultural control is based on the concept of socialization where informal personal interaction is very significant. A considerable amount of resources is used for training individuals so that they can share a homogeneous corporate culture. Centralized and decentralized control. Control may be centralized. The parent unit maintains control over the operation of the entire firm and the subsidiaries get the least freedom. Decentralized system, the subsidiaries get greater freedom to control their operation. So, centralized of control is favored when the firm is faced with a global competitive threat. When a large amount of research and development is involved in the manufacturing of product, or when cultural similarity is found between the home country and the host country. However, centralized of control is normally not feasible when the subsidiary is marked with the host country dominance. Decentralized should be the design of control when the subsidiaries has only marginal involvement in overall international business, when product is a customer product, and when the human resources of the subsidiary is capability of taking the important decision.
Third, the assigned topic that I will be discussing is all about international investment and financing strategy. 14.1 International Capital Budgeting. There are different methods of capital budgeting, such as accounting rate of return, payback period, net present value, internal rate of return, profitability ratio, and so on. So, the purpose of these techniques is to find out whether the cash inflow is greater than the cash outflow. Some of the techniques are discounting techniques where future cash flows are discounted to the present value and then they are compared with the initial investment. Nevertheless, the discounting and non-discounting techniques apply to both domestic capital budgeting and international capital budgeting. Net present value or NPV is present value of future cash flow minus initial investment. NPV or net present value is the lifetime value of an investment discounted to present value. The NPV formula is commonly used in investment banking and accounting to determine whether an investment project or business is profitable in the long run. Internal rate of return or IRR is the discount rate equating future cash flow with initial investment. Internal rate of return or IRR is a metric used in financial analysis to assess the profitability of potential investment. IRR is the discount rate that makes the net present value or NPV of all cash flows equal to zero in discounted cash flow analysis. The IRR calculation is based on the same formula as the NPV. Profitability ratio is present value of future cash flow divided by initial investment. Profitability ratio is a type of accounting report that helps determine a company's financial performance at the end of the reporting period. The profitability ratio show how much profit a company can make from its operation. The salvage value refers to sale proceed of assets at the end of the life of the project. Salvage value is the estimated value of an asset at the end of its useful life that can be resold, or it can be called the book value of an asset after all depreciation has been calculated. Computation of the cash flow. Any investment for a new project demands a part of the firm's current wealth, but in return, it brings in funds and adds to the firm's stock of wealth in the future. The former results in cash outflow from the firm, while the latter is represented by cash inflows into the firm. Cash outflow occurs on account of a capital expenditure. Other expenses, including depreciation and the payment of tax. Cash inflow includes revenue on an account of additional sale or cash from eventually selling of an asset, which is known as salvage value. Thus, cash flows are grouped under three heads. One is the initial investment during the period, the other is the operating cash flow during the period, and terminal cash flow or the salvage value that emerges at the end of the period. Complexities in cash flow computation. The computation of cash flow is complex in international firms. At the very onset of multinational capital budgeting, a decision needs to be taken regarding whether the cash flow should be computed from the viewpoint of the parent company or from the viewpoint of the subsidiary. This is because the cash flow accruing to the subsidiary may not be represented entirely by the cash flow accruing to the parent company. In some cases, the cash outflow of the subsidiary is treated as the cash inflow of the parent company. The parent perspective. These factors operating at different stages of cash flow need to be analyzed. The computation of cash flow in the context of international capital budgeting incorporates factors that influence the very size of the cash flow at different stages. Initial investment. If the entire project cost is met by the parent company, the entire amount of initial investment is treated as the cash outflow. So, in some cases, the project is partly financed by the subsidiary itself through local borrowing, but such borrowings of the subsidiary do not form a part of the initial cash outflow. Again, in some cases, the subsidiary makes additional investment for expansion out of the retained earnings. At the first instance, there is apparently no flow of cash from parent company to the subsidiary. Block funds. Profit of subsidiary not repatriated to parent due to exchange control. So block funds is very pertinent in this respect. Sometimes the host government imposes exchange control and does not allow any cash to flow to the parent company. These funds are known as block funds. Thus, this part of the cash inflow of the subsidiary, which is represented by block funds, is not treated as cash inflow from the parent perspective. Operating cash flow. The operating cash flow is computed on after-tax basis as well as on incremental basis. Operating cash flow does not consider depreciation as it in a non-cash expense. Depreciation, however, helps arrive at the pre-tax profit. Financing cost is also not included despite the fact that capital has a cost. The reason is that such costs are considered elsewhere while determining the project required rate of return. If the operation in the subsidiary leads to import of components and raw material from the parent company, the value of such imports will be added to the revenue. Operating cash flow influenced by transferring pricing. When the parent company or any other unit of the firm charges arbitrary prices for intra-firm movement of intermediate goods. So transfer pricing is adapted with either for better working capital management or for reducing the overall burden of taxes of the company through shifting of the before tax profit to a country with lower tax rates. If transfer pricing lowers the overall tax burden of the company and thereby increase the revenue of the parent company, the additional revenue or savings should be treated as cash inflow. Incentives should be included in the capital budgeting decision. So, for example, if the host government offers tax incentives or provides loans at subsidized rates, the amount of the gain on this account should be added to the operating cash inflow. So, the local borrowing. For meeting a part of the initial investment and pays interest on such borrowings, the amount of interest payment is deducted from the operating cash inflow. So, local borrowings is separated from the investment made by the parent. The present value of cash flow received by the parent company should take into consideration the interest paid by the subsidiary on the local borrowing, and only then should it be compared with the initial investment made by the parent company. Inflation rate differential needs to be taken in our account. Inflation influence both the cost and revenue streams of the project. If the inflation rate is higher in the host country, and if the import from the parent company constitute a significant portion of the input of the subsidiary, the cost will not become very high. But if the inputs are obtained locally, the cost will become very high. Also, as far as revenue is concerned, it will move up if there is no competition from foreign suppliers and if the demand for the product is priced inelastic. Exchange rate fluctuation influences the size of the cash flow. It is a fact that changes in the exchange rate are tagged to changes in the rate of inflation. But there are other factors too that shape exchange rate fluctuations. It is difficult to predict the behavior of all those factors. Nevertheless, the cash flow computation process incorporates different scenarios of exchange rate movements. From the parent company's point of view, appreciation in the currency of the host country will be favorable and will increase the size of the cash inflow in terms of the home country's currency. Terminal cash flow. Besides adjustments in the initial investment and the operating cash flow, some adjustments have to be made for the salvage value that influences the terminal cash flow. If there is a provision in the foreign collaboration agreement for the reversion of the project to the host government after a certain period of time on the payment of specific account, the specific amount is treated as the terminal cash inflow. 14.2.1 Minimization of cost of funds. The effective cost of funds depends entirely on the rate of interest and the changes in the exchange rate or in the value of the borrowed currency. In the form of an equation, the effective cost of borrowing from a foreign market is the KBR, open parenthesis 1 RF, close parenthesis, open parenthesis 1 EF, close parenthesis minus 1. So R is the rate of interest in the foreign market and E is the change in the exchange rate. Suppose the interest rate in the London money market is 12% compared to 14% in New York, and the pound sterling is expected to appreciate by 4%. The effective cost of borrowing in pound would be open parenthesis 1.12 and 1.04 close parenthesis minus 1 is 16.48%. So in this case, the multinational enterprise will borrow from the New York money market despite the fact that the rate of interest is lower in the London money market. This because the effective cost of borrowing pounds is greater than that of borrowing dollars. In cases where the firm borrows from more than one financial market, the weighted average of the effective cost of borrowing in different currencies is computed. Again, the effective cost of total borrowing will be lower if there is negative correlation in the movement of the value of different currencies. Borrowing to conform to capital structure norms. The study of Sikely and Collins, 1988, examines the capital structure norms among 677 firms in 9 industries in 23 countries and finds that the debt ratio may be large or small depending upon economic, social, cultural, and political factors. So, since these factors vary among countries, capital structure norms also vary widely among countries. On the whole, debt ratio is found to be large in the Scandinavian or Mediterranean and some Asian countries. It is low in case of some of the South Asian, Latin American, and Anglo-American countries. In this context, an important question arises regarding whether the Affiliates of multinational corporation should follow host countries' norms, or they should be guided by the parent company norms. If the norms in the home country and the host country are similar, there is no problem. Selection of an optional maturity. Long-term capital is more liquid but lower profitability. Short-term capital may push up profitability but is less liquid. The finance manager uses perfect trade-off between short-term capital and long-term capital. So the international financial market, a market multinational firm, likes to maintain a proper balance between short-term liabilities and the long-term liabilities. There is no confusion in case of financing fixed asset because they are financed with long-term capital. But in case of financing of current assets, a decision needs to be made regarding the ratio between the long-term capital and the short-term capital. The normal view is that permanent current assets should be financed with long-term capital and the fluctuating part of the current asset should be financed with short-term capital. This is nothing but a trade-off between liquidity and profitability. 14.2.4 Avoidance of legal and procedural formalities. Any firm raising funds does not like to undergo too many procedural formalities. From this viewpoint, the issue of international bonds is complete much more than in the case of euro notes. Again, the borrowing program can be designed only within the framework of a local laws. If the government prohibits the issue of the particular instrument, the borrower cannot issue it despite its cost efficiency. 14.3 Financial swap. Very often, a borrowing firm may not have easy access to a segment of its own choice in the financial market. For example, a firm needs fixed rate funds but has an easy access to floating rate funds. Similarly, a firm needs borrowing from the US dollar market but has done easy access to the euro market. In this case, it can borrow the funds from easily available sources and then can exchange its liability into another form of liability of its own choice. This exchange is called a swap. 14.3.1 Interest rate swap. The interest rate swap refers to exchange of interest payments through a swap dealer, normally between fixed rate loans and floating rate loans. It usually occurs when a person or a firm needs a fixed rate funds but is only able to get a floating rate funds. It finds another party who needs only floating rate loan but is able to get fixed rate funds. The two known as counterparties exchange in the interest payments and the loans according to their own choice. It is the swap dealer, usually a bank that brings together the two counterparties for the swap. The interest rate swap will take place in the following stages. Stage 1, if a firm A has access to the floating rate loan market, it will be borrow from the floating rate loan market. Similarly, firm B having access to the fixed rate loan market will borrow a fixed rate loan. Stage 2, both the counterparties approach a swap dealer. Since firm A needs a fixed rate loan, the swap dealer asks firm A to pay fixed rate interest to its swap dealer. As if it has borrowed fixed rate loan, the fixed rate of interest payable through the swap dealer is higher than what firm B has to pay to be lender in the fixed rate loan market, but lower than what firm A has to pay to the lender. If it had borrowed from the fixed rate loan market, it is say 9.75% in exchange. The swap dealer pays firm A the interest at the 6-month LIBOR. Firm A pays LIBOR 0.3% to the lender on its floating rate borrowing. On the other hand, the swap dealer asks firm B to pay 6-month LIBOR as if it has borrowed a floating rate loan. In exchange, the swap dealer pays firm B a fixed rate interest, which is higher than what firm B has to pay to the ultimate lender. This is the interest rate that swap dealer has received from firm A minus its swap dealer's own commission. It is says 9.65%. Her firm B gets interest from the swap dealer at 9.65%. Here, firm B gets interest from the swap dealer at 9.65% and pays interest to the fixed rate lender at 9.50%. Repay the loan. Firm A repays the floating rate loan and Firm B repays a fixed rate loan. Firm A is attracted to the swap deal as if it uses the loan according to its own choice, and also because the fixed rate of interest payable pay is lower than what it had to pay in case it borrowed from the fixed rate loan market. Firm B is attracted to the swap deal not only because it is using the loan according to its own choice, but also because the swap dealer gives an interest rate that is higher than what it has to pay to the ultimate lender. The swap dealer is attracted to the swap deal because it earns from such a deal. 14.3.2 Currency Swap. Currency swap is exchange of one borrowed currency for the other borrowed currency through a swap dealer. A currency swap is different from the interest rate swap insofar as it currency swap involves two indifferent currencies. Suppose firm A can be borrowed a euro at the fixed rate of 8.0% of the US dollar at a floating rate of 1-year LIBOR. Firm B can borrow euro at a fixed rate of 9.2% and can borrow the US dollar at 1-year LIBOR. If Firm B needs the fixed rate euro, it will approach the swap dealer, provided that Firm A needs the floating rate of US dollar. The swap deal will be deducted in different stages as follows. In the first stage, Firm A borrows euro at 8.0% interest rate. Firm B borrows US dollar at LIBOR. In stage 2, the two firms exchange the borrowed currencies with the help of the swap dealer. After the exchange, Firm A will possess US dollars, Firm B will possess euros. In stage 3, Firm A will be LIBOR on the US dollar that will reach the US dollar market first through the swap dealer and then through Firm B. Firm B will pay a fixed rate interest that will flow the fixed rate DM market through the swap dealer and through a Firm A. Firm B will pay a fixed rate of interest to the swap dealer which will be more than 8.0% but less than 9.20%. It will be, say, 8.60%. The swap dealer will take its own commission and shall pay to firm A in this case only say 8.40%. In stage 4, two principals are again exchanged between the two counterparties. Firm A gets back euro and repays them to the lender. Firm B gets back US dollars and repays it to the lender. 14.4 International Cash Management. In an international firm, management of cash is complex task in view of intra-firm transfers of cash in the restriction imposed on them by the home and the host government. The management of cash basically involves 4 steps. They are assessment of the cash requirements, optimization of cash needs by restructuring inflows and outflows, selection of sources from where cash could be brought in, investment of surplus cash, if any, into near cash assets. 14.4.1 Assessment of the cash requirements. For the assessment of cash needs, a cash budget is prepared for each subsidiary. The first step in international cash management is to establish the need for cash during a specific period, which may be a week or fortnight or a month. After assessing the cash needs of each of the subsidiaries, the figures are consolidated in order to assess the cash needs of the firm as a whole. It is because in a multinational enterprise, it is the cash flow of the firm as a whole that is taken into account and which needs to be managed.